Hi guys, let's talk about 7 biggest Bitcoin myths. With Bitcoin hitting new all-time highs and major news breaking almost every day, it seemed like a good time to look at some of the biggest myths and misconceptions people tend to have about the world's first cryptocurrency. See if they have any merit and correct the record. If you think, for instance, that Bitcoin's value is based on nothing, or that it's no volatile to have any real world use, this guide is for you. We are separating fact from fiction without shying away from legitimate risks to get the truth about the world's most popular cryptocurrency. First, Bitcoin is a bubble. While it's true that some people buy Bitcoin as a speculative investment seeking big returns, that doesn't mean that Bitcoin itself is a bubble. Bubbles are economic cycles characterized by unsustainable rises in market value. They eventually pop when investors realize prices are much higher than an asset's fundamental value. Bitcoin is occasionally compared to an infamous early speculative bubble. The 17th century Dutch tulip mania in 1637, speculators caused prices for some tulip varieties to surge 26-fold. The bubble lasted 6 months, crashed, and never recovered. The real story: Bitcoin has gone through multiple price cycles over the course of over 12 years and has recovered each time to achieve new highs. As with any new technology, boom and bust cycles are expected. For example, at the end of the .com era in the 90s, Amazon stock nosedived from around $100 to just $5, only to become one of the most valuable companies in the world in the subsequent decades. Some major Bitcoin investors believe that Bitcoin's oscillations form a pattern typical of young markets. Bitcoin, they say, will surge and recede with smaller swings and longer durations between them until at some point in the future it settles into relative stability, but only time will tell. Second, Bitcoin has no real world uses. Critics like to claim that Bitcoin isn't useful in the real world, or if it does have a use, it's mostly useful for illicit activity. Neither of those statements are true. Bitcoin has a long story as a means of making payments to anyone in the world, all without a bank or payment processor in the middle. And it is increasingly being used as a gold-like hedge against inflation by major institutional investors. The real story: in recent years, Bitcoin has become increasingly popular as an inflation resistant store of value, much like gold, leading to Bitcoin's digital gold nickname. A growing number of major funds and publicly traded companies have bought millions or even billions of dollars worth of Bitcoin as a means to better manage their assets. Much like gold, Bitcoin is scarce. Gold, of course, is heavy, bulky, and difficult to transport and store. Bitcoin, on the other hand, can be sent digitally as easily as sending an email. Bitcoin received negative attention in early years as a means of payment on the dark web. But when the first big dark web market was shattered, Bitcoin prices went up after just a few days and continued to rise. Like any form of money, some of it will be misused. But compared to US dollars, illicit use of Bitcoin is a drop in the bucket. According to a recent report, 2.1% of Bitcoin transaction volume in 2019 was related to criminal enterprise. And because all Bitcoin transactions happen on an open blockchain, it's often easier for authorities to track illicit activity than it would be in the traditional financial system. Myth third: Bitcoin doesn't have real value. While Bitcoin might not be backed by a physical asset like gold, neither is the US dollar or virtually any other modern fiat currency. Bitcoin is hard coded to be scarce, which helps make it resistant to inflation. Inflation with fiat currencies can occur when large quantities are created, thus dilating the existing supply. The real story: there will only ever be 21 million Bitcoin. This scarcity is a major driver of its value. Not only is the supply capped, but the amount of new Bitcoin being mined is declining over time in a predictable way. Every 4 years, in an event called a halving, block rewards paid to miners in the network are cut in half. This helps ensure that the supply is always reducing, which, by the basic economic principle of scarcity, has worked to keep the price of Bitcoin broadly tending upwards over the long term, from less than a penny at the start to more than $50,000 as of mid February 2021. Bitcoin also derives value from the work the computers on the network contribute via a process called mining. Powerful computers all over the world supply a vast amount of processing power towards the work of validating and securing every transaction. So guys, we'll end this interesting video. Goodbye.